Title: Accounting Made Easy, Active versus Passive Accounts. Sabrina. Good morning, everyone. Today, we're going to learn the basics of accounting. We'll talk about active and passive accounts. Can anyone tell me what they think that means? Sabrina draws a large active accounts box on the whiteboard, labeled Assets. Inside the box, she draws a house, cash, and a calculate. Sabrina. Let's start with active accounts, also called assets. These are things your company owns and can use to make money. Mark, can you think of an example? Mark. Well, if I buy a laptop for my business, that would be an asset, right? Sabrina. Exactly. Your laptop is an asset because it's something you own that helps your business run. Other examples are cash, equipment, and inventory. Sabrina shows a simple graphic. Cash, money you have. Inventory, items you sell. Equipment, tools or machines you own. Sabrina now draws a box on the whiteboard labeled Passive Accounts or Liabilities. She draws a bank building and a credit card. Sabrina. Now, let's talk about passive accounts, also known as liabilities. These are amounts you owe to others. Daniel, can you think of an example of a liability? Daniel. Maybe if I borrow money from the bank, that would be a liability, right? Sabrina. Exactly. The money you owe is a liability because it's something you need to pay back. Other examples are loans, credit card debts, and accounts payable. Sabrina shows a simple graphic. Loan, money you borrowed from the bank. Credit card debt, money you owe on your credit card. Accounts payable, money you owe to suppliers. Sabrina points to Mark's desk where he's holding a piece of paper with numbers written on it. A simple chart appears on the screen next to Mark. Sabrina. Let's see an example. Mark has started a small business. He borrowed 500 euros from the bank and he bought a laptop for 300 euro. Now, let's look at his accounting. Mark. So, the 500 euros I borrowed is a liability and the laptop I bought is an asset, right? Sabrina. Correct. Now, let's record it in the accounting system using T accounts. On the whiteboard, 2 T accounts are drawn. Asset, laptop. Asset, laptop. Debit, credit. 300. Balance, 300. Liability, loan. Liability, loan. Debit, credit. 500. Balance, 500. Sabrina. We record the laptop as an asset and the loan as a liability. Can everyone see how we've used the T accounts to track what Mark owns and what he owes? Natalia. So, if Mark buys more things, like a printer, how would he record that? Sabrina. Great question, Natalia. Let's say Mark buys a printer for 100 kilo. If he uses cash to pay for it, it reduces his cash asset but increases his printer asset. On the whiteboard, 2 more T accounts are drawn. Cash, decreased. Cash debit, credit, 100 balance, 200 printer, new asset. Let's review. Active accounts are things you own, like cash, equipment, and inventory. Passive accounts are things you owe, like loans and credit card debt.